Hey there, everyone. Welcome to Broadband Deployment News and some breaking news today. The NTIA has approved some alternatives to the letter of credit requirement for the BEAD program. Be right back with some details. Thanks for joining me, Rick Uzzi here with Broadband Deployment News. So this is good news, especially for smaller to mid-size operators that we're looking at the BEAD program and realizing that either they were going to have to pass on taking BEAD funds because of the letter of credit requirement, or possibly realizing that they would not be able to use the funds as much funds for broadband deployment. In some cases, they were saying, at least 25%, obviously maybe 30 to 35% would not be able to go toward deployment in order to be able to deal with that letter of credit requirement. So that's good news, and I wanted to talk about this today and look at what we've got here as far as from the NTIA. What they've said is now allowable. So you see here, this is in their blog, and this was effective today. You see this came out, ensuring robust participation in the BEAD program. So that's part of what they're trying to accomplish here with their change here to the letter of credit requirement and what they're going to allow, because this is really the argument against the letter of credit from a lot of providers and other stakeholders, was that by having that in place, you're going to have less participation, especially from those that the NTI was trying to encourage to participate, which would be, let's say, smaller community-based kinds of providers versus big national providers that maybe can afford something like that letter of credit. So this is good news, and we'll take a look here and see what we've got. So see here, the BEAD, it talks about the BEAD program and how it's only going to succeed if every penny is wisely spent. So, the goal of the letter of credit, it has a worthy goal, which is to make sure that any taxpayer funds that are put towards broadband deployment in this program are used properly, and that it's going to people that can do this the right way, that are not going to give up midway and those kinds of things. So they want to make sure that the companies have a stake in this, that they've got a lot of skin in the game. But the issue was it was maybe a little too much of that, and because of that, it was interfering with the other goal of the program, which is to make sure again that we've got, number one, good participation from providers of all types and all sizes, and then secondly, that we're taking that money and using it effectively for the goal of the program, which is to deploy broadband to as many, hopefully every unserved and underserved location in the country. And if you're taking right off the top 25% of the dollars that a operator can use and locking that up for the entirety of the program that they're building it, then that number one locks out a lot of providers from doing it, and then secondly, again, you're not using those funds for building broadband. So that's what we're trying to accomplish here. So it talks about being a good steward of taxpayer dollars. That's important. And it says here, the NTIA took action to strengthen our commitment to both objectives, releasing a programmatic waiver of the letter of credit requirement and the BEAD notice of funding opportunity. Under NOFO, prospective subgrantees, and they're talking right now about what's in the notice of funding opportunity, and this is what they've got the waiver for. So under the NOFO, there's an irrevocable standby letter of credit to the eligible entity. The 50 states or the 5 territories and DC would be the eligible entities in the NOFO before entering into a subgrantee agreement. So they've got to get this letter of credit. This is up front before any funds are provided. Anybody that wanted to do this build had to get this 25% letter of credit. The amount of the LLC must be no less than 25% of the sub-award amount. This requirement helps states and territories ensure that potential BEAD applicants have the financial capacity to deliver reliable, affordable, high-speed internet service. So again, this is the original language, so to speak, of the NOFO, this 25% letter of credit upfront. The NOFO acknowledges that prospective subgrantees may be able to or required to demonstrate their capability in a variety of manners, and urges states and territories to accommodate these differences in establishing their requirements, inviting alternatives if they are necessary and sufficient to ensure that program's objectives are met. So they were saying there was some leeway from the states, but this waiver that they're providing today provides a lot more comfort to the eligible entities, the states, on what they can do, and certainly it's kind of pre-approved, if you want to look at it that way, that these kinds of things can be done. Some stakeholders, it says, have noted that the LOC requirement may have an adverse effect on smaller providers and could prevent them from participating in the BEAD program. To address these concerns, the waiver released today modifies the LOC requirement for subgrantees of all eligible entities in the following ways. So this now is official, where this is another option for the eligible entities to be able to provide to the subgrantees. So that would be the states, territories, to be able to provide to the internet service providers that are going to be getting the subgrants to build the networks. So first off, allow credit unions to issue LOCs. So rather than having to go to a bank, which a lot of times can be more expensive, if you have a local credit union that you're doing business with or can do business with, you may be able to get better rates, I suppose, and get that done less expensively. So the NOFO requires subgrantees to obtain an LOC from a U.S. bank with a safety rating issued by WISE of B or better. The waiver permits subgrantees to do the LOC utilizing any United States credit union as long as they are have a safety rating issued by the WISE of B minus or better. So by WISE of B minus or better, I guess that's some kind of credit rating. So anyway, so credit union option is in addition to a bank. And then also the use of performance bonds. This is something that a lot of stakeholders brought up as a possible option. With a letter of credit, you got to take that amount of money, that 25%. So 25% of what the build is going to be. So let's say you're going to get, just a round number, let's say you're going to get $10 million to be able to do this build out. Well, you got to take 25% of that, $10 million, and you've got to set that aside. And that, basically you're getting 10 million. So really you got to take 25% on top of that, I guess, and set that aside in the bank so that you then have that money secured in a sense. It's just got to sit there. It's not doing anything. It's just there to help the NTIA feel secure that you've got money in the bank, so to speak. But that's, again, taking 25% that could be used, that the company could use to build broadband, and now they're going to have to, maybe could be used to do their match, but now they're going to take that and stick it aside and not do anything with it. So that's the problem with the letter of credit. Performance bonds are a little different. In fact, I've got something here we can look at real quick. So, and by the way, I linked to these things in the description, if you want, including this, if you want to take a look at that. So you can see a surety bond, and I think it's very similar, if not the same as a performance bond versus a letter of credit. So cost-wise, customers pay a premium of around 0.5% to 10% of the bond's amount. And the premium rate is determined based on the underlying risk, that kind of thing. Here on the letter of credit, banks will typically charge an annual fee of around 0.5 to 1% of the LOC amount. So you've got that charge, but in addition to that, you've got all of the money. So you got the 25%. So you've got, again, $1 million or $10 million, whatever, you got to take 25% of that, and that's got to go in there. Plus, you've got to pay these annual fees. Collateral requirements. Most surety companies do not require collateral deposit. Of course, on the letter of credit side, you've got the collateral. You've got that 25% that was going to be required or still is required if you're going to do the letter of credit under the BEAD. But in this case, you do have the option of a performance bond. Claim payments. Surety companies have the opportunity to adjust a claim, meaning that they can review the applicable statutes and deny an invalid claim. I don't know how important that is. Banks must pay out claims. And then working capital impact, that's the big thing as well. So businesses, for a performance bond, surety bond, businesses simply pay an annual premium to purchase a surety bond or a performance bond. So you got to pay a premium, but it's not really impacting your working capital other than you've got to pay that. But of course, you still got to pay annually for this letter of credit. But on a letter of credit, you are taking that, basically that working capital, and putting it aside and not doing anything with it. Banks require collateral deposit to obtain a letter of credit. Funds on deposit are reserved and unavailable to the business as long as the letter of credit is outstanding. And with the BEAD NOFO, it's basically outstanding through the length of the project, so the entire time. And again, you've got to have that money before ever getting any funds. You've got to have that set aside. Then it's got to sit there in the bank the whole time. So obviously much better terms here as far as the performance bond for service providers if they want to use that. So that's important. You can see here that, oh yeah, I mentioned that. So it's got to be, no, I'm sorry, here it is. So the waiver permits a subgrantee to provide a performance bond equal to 100% of the BEAD subaward amount in lieu of a letter of credit. So they have to get a performance bond for 100% of the amount. Now, this doesn't mean that they have to have 100% of their subgrant. It's going to be, they've got to pay a premium based on the amount. So, but it does have to be 100% in this case, although there is some wiggle room there, which we'll see here in a moment. And then here, they can allow eligible entities to reduce the obligation upon completion of milestones. This was something else that was suggested, and it makes perfect sense. And a lot of people were looking at what was being required under RDOF, the Rural Development Opportunity Fund. And there you had to have these letters of credit, but they were only 10%, and you got your money first. And I think over certain periods of time, that letter of credit could reduce as certain milestones were hit. So I think they are kind of looking at adjustments like that. So the waiver allows an eligible entity reduce the amount of the letter of credit obligation below 25% over time, or reduce the amount of the performance bond below 100% over time upon a subgrantee meeting deployment milestones specified by the eligible entity. And there's a few more details on how that might work and what we're going to look at here in a minute as we look at the actual waiver. And then fourth, allow for an alternative initial letter of credit or performance bond percentage. So even though they're saying 25% letter of credit and 100% performance bond, they again are providing a little wiggle room there. It says the NOFO requires that the initial amount of the letter of credit be 25% of the subaward, or the initial amount of the performance bond be 100% of the subaward. The waiver, in the option above, the waiver allows the initial amount of the letter of credit or performance bond to be 10% of the subaward amount during the entire period of the performance when an eligible entity issues funding on a reimbursable basis consistent with section blah, blah, blah of the NOFO, and reimbursement is for periods of no more than 6 months each. So in other words, the eligible entity has some leeway there to reduce the letter of credit to 10% and the performance bond to something less than, let's say, that as well to 10%. So from 25% to 10% on both of those, as long as this particular section in the NOFO is taken into account. And what that says, this is on page 51 of the BEAD NOFO. So it's basically to ensure grantee accountability. So again, that's what they're trying to do here. So for example, just a highlighted part here, each eligible entity must include sufficient accountability procedures within its program to ensure subgrantee compliance with all applicable program requirements. Each eligible entity must at a minimum include any subgrant agreement reasonable provisions allowing for recovery of funds in the event of a subgrantee's noncompliance with the BEAD program's requirements, including but not limited to, and it mentions failure to deploy the network, et cetera. And then it says, allow the eligible entity to withhold funds if the subgrantee fails to take actions. The funds are meant to subsidize, and then the inclusion of a drawback or clawback provision where you've given out funds, but then you can claw that back. So they just want to make sure that, and this is more protection, right, for the government and for taxpayers. So it just want to make sure that the eligible entities can, stop providing the funds if things aren't going well, and claw back funds if they aren't going well. So what we're just looking at there is the section that they're talking about. So this works as long as that section 4C1B of the NOFO and reimbursement is for periods of no more than 6 months each. By providing an expanded universe of potential issuers of LOCs and specific permissible alternatives to the LOC requirement, NTIA remains faithful to our objectives of encouraging robust participation from a broad range of service providers while giving states and territories more ways to ensure that grant recipients can build a high-quality network and operate it for years to come. We appreciate those stakeholders who brought both their concerns and good solutions to the table. So again, they did get a lot of good feedback from several individuals and groups, and it looks like they've acted on that. So we can also look now, this is a link to this again. So this is kind of their blog post, or if you will, press release, so to speak, on them doing this today. And this is the specifics, and there's a link to it in here as well on this document, but I've got it linked in the description of the video here. So this is the BEAD letter of credit waiver, notice of programmatic waiver. That's hard to say. And then it's basically everything we just read, but it just goes into more detail. So again, it's got the background here, and it's got the different, the different things that can be waived here, 1, 2, 3, and 4 with a little bit more detail. So let's take a quick look, see what we have here. So LOC requirement is waived only to the extent and to and as described below. And it mentions the credit unions. Again, it mentions the insurance has got to be in place. And then it says the LOC requirement is waived where during the application process, prospective subgrantees are required to submit a letter from a company holding a certificate of authority as an acceptable surety on federal bonds as identified in the Department of Treasury circular. So there's more details here on that. Let's see. Prior to entering any subgrantee agreement, each prospective subgrantee obtains performance bond acceptable in all respects to the eligible entity and in a value of no less than 100% the subgrantee amount. I wonder if that 9 refers down here, because again, there is some wiggle room there. Let's see what else we got here that's of interest. Oh, and also it mentions that where a subgrantee chooses to exercise the option to obtain a performance bond, the requirement where they have to get legal counsel, there's a letter of credit requirement that says you have to get some legal counsel stating that if you go bankrupt, then your letter of credit can't be used to satisfy some of that bankruptcy. So basically, that letter of credit's got to stay where it is and it's got to apply to what it was meant for. Well, if you're doing the performance bond, that's not required. So it mentions that. It mentions the reduction of the LOC performance bonds upon completion of milestones. So that again, if the state reaches or comes up with certain milestones that can be met, then that is acceptable. And it gives an example here. By way of example, an eligible entity could specify that a subgrantee may obtain a new letter of credit or renew its existing letter of credit to reduce its value in accordance with the following limitations. So, for example, upon demonstrating to the eligible entity or the state that it's completed build-out of 40% of the locations to be served, the subgrantee may obtain a new letter of credit or renew its existing letter of credit so that it's valued at no less than 20% of the award amount instead of 25%. And again, this is just a suggestion. It could be that the state will be a little bit more generous here to be able to get more folks to be able to perform. Again, they think they've got some leeway. It just says by way of example. And again, by way of example, once they reach 60% of the locations, then it goes down to 15% on the amount of the LOC. Once they build out 80%, then it goes down to 10% of the LOC. And once they have demonstrated satisfactorily that they've completed 100%, subgrantee may terminate the letter of credit under the terms set forth therein. And then it also mentions here, second section here, subgrantee option for alternative initial LOC performance bond percentage. It's a very similar thing, I think. The requirement that the initial letter of credit be 25%, or in the case where a subgrantee chooses to utilize a performance bond, allow the initial amount of the performance bond to be lower than 100% of the subaward amount, where, and I'm assuming they mean the letter of credit to be lower than 25% of the sub amount as well. So those two things together, it doesn't kind of track with this language, but they said that, I think, in the blog post we were just reading. So it's 25% LOC or 100% performance bond could be lower, provided that the eligible entity issues funding on a reimbursable basis consistent with that section that we looked at in the NOFO. And that reimbursement is for periods of no more than 6 months. We saw that. The subgrantee commits to maintain a letter of credit or performance bond in the amount of 10% of the subaward until it has demonstrated to the eligible entity that it's completed the build-out of 100% of the locations to be served by the project, or until the period of performance of the subaward has ended, whichever occurs first. So there you go. A few more details that were basically explaining some of this that's in the blog post. So again, this is really good news. It's something that we were kind of expecting that they were going to do something, because they said they received a lot of feedback. They were taking under advisement and would be getting back to everyone. So that's what they've done now. So this is good news, again, especially for smaller and even mid-sized operators. There was a webinar I was watching the other day that had a couple of mid-sized operators that were speaking about it. I think Brightspeed was one of them. I can't remember the other. And they were saying, you know what, for us, it may cause us to pass on some locations that we otherwise would have built in. And then on those locations that we do build in, it's just going to mean we're going to be able to deploy to fewer locations. So I think this is good news for pretty much everybody. And it does make sense because, again, this was much harsher than the letter of credit requirements in RDOF awards because of the fact, again, that you had to set all this aside prior to ever getting any money. And then also it's, 25% the whole time. There was no milestones. So this, and, with the addition of the performance bond, even better. So again, that's much less onerous for a small operator that doesn't have that kind of capital that they can set aside that's not going to be used. And that's really was the big thing that was going to be difficult for a lot of smaller operators. So good news there. So again, a little breaking news today, and hope this was helpful, or that you learned something today. If you did, if you would give me a like on the video, I'd appreciate it. And if you're not subscribed, click the subscribe button, ring the bell, and you'll be notified when I'm live. Thanks for joining me today. I'll see you next time. Bye-bye.